Location. Location is the most important thing when it comes to real estate. At least that's what everyone says. And I agree. But to me, locations have to be evaluated not based on geography alone, but based on how they measure up in relation to supply and demand. After a location has met the criterion of being in an area with good employment prospects and a growing population, I look for a few important physical features that experience has shown to be valuable. Great locations have drive-by visibility. The more cars that pass by your property and see your "For Rent" sign, the better your chances of success. Drive-bys are one of the most effective forms of advertising and certainly one of the most cost-efficient. Great locations possess a rare quality. There's a one-of-a-kind quality about great locations that you can't find everywhere. Our Portland project was one of the only waterfront properties left in a wildly popular area. It was an island waiting to be found. That's the rare quality I'm talking about. Great locations are in demand. Some investors think they can't afford to even look at property in the hot locations. I hear this often at Rich Dad seminars. But the truth is, affordability is everywhere, even in the hottest neighborhoods, if you buy the property based on operational performance and not on the sale price. You'll be hearing more about this concept a little later, but for now, know that you should never rule out A-plus neighborhoods. Take another look at these three characteristics of great locations, and what you find is that they add up to one simple truth. Great locations are low in supply and high in demand. This is at the heart of your market evaluation. Be realistic with your analysis and look at the future of the market with a keen eye on the present. Property investing should pay off now and later. The first step in buying right is knowing your market better than anyone else. Focusing your market. After all the evaluation is said and done, you should be armed with the information you need to narrow your market. Earlier, we talked about goal setting. Let's say your goal is to acquire one 8-unit property in the Phoenix metro area within the next 12 months that will generate at least $4,000 of average annual income over the next 5 years. After listening this far, you should now be thinking that the Phoenix metro area as a market is way too broad and that it should be narrowed considerably. As you learn more about your own market, you will find yourself continually refining your goal and your search. That's perfectly fine. This gradual focusing is necessary, and those who can't do it effectively find this type of work, well, a lot of work. So let's now refine our market to Scottsdale. That's much better. And we'll focus it even further to the Old Town area, a submarket of Scottsdale. I now know that my property choices will be in the hundreds, not in the tens of thousands. Do you see what I mean about a lot of work? Focusing your market makes things manageable. Finding your diamond in the rough. Identifying investment property is like dating. You want to make sure you choose wisely because you will be committing time, energy, and money. You'll be putting your heart into the effort and have big dreams of where things may lead. Maybe a long-term commitment, maybe marriage. Dating just anyone, like targeting any old property, can be a huge time waster and even cost you a lot of money. I speak from experience on both counts. In real estate investing, you can see that choosing wisely involves setting a goal, building your team, and evaluating your market. There's a lot of preparation required before you actually select a property. And what you are looking for isn't necessarily the winner of the beauty pageant, but a diamond in the rough. This is the one with the most potential, and potential, as you'll see later, means bottom line dollars. Time and time again, investors start at this stage. They work on finding a property and completely skip the preparation work. This is why the word risk is so often associated with real estate. Selecting the property should come only after you have assembled a team to assist you, decided upon your goal, and have done the work of identifying a market or submarket. Never should have come before. It requires a level of trust, but like I always say, trust but verify. By now you have found your market and a submarket or submarkets within it. The next step is finding the property that will achieve your income and profitability goals within your chosen area. This section and the one that follows are critical to your success in this business because this audiobook isn't about just buying property. It's about buying property right. For the right price, in the right area, with the right expectation to achieve your goal. This is the only way I buy, and the reason is simple. When you buy right, you spend your days tending a garden rather than digging out rocks. Life is too short. Setting target property parameters. Let's go back to the hypothetical goal of finding an 8-unit property within the next 12 months that will generate $4,000 of average annual income. We've focused our market to the Old Town area of Scottsdale. Now it's time to focus our property parameters. We need to get more specific about our 8-unit property. When I was just starting out in this business, I searched for property myself. Now I hire somebody to sift through property that is listed and not listed to find what fits my parameters. You might think that's a luxury only established investors can afford. Not so. The person who works for me is a broker, and he gets paid when he finds a deal that closes. Anyone can afford this kind of help. For me, it helps a lot to have a precise idea of the kind of property I'm interested in. It saves a lot of time, keeps my broker and me focused, and helps me make the work manageable. I am very specific about what I want to consider. For example, we're looking in one market right now for a 150-plus community in a good location with high visibility, drive-by traffic on major streets, and constructed after 1988. Even more specifically, I'm looking for owner-managed properties where the owners live out of state and have just 1 or 2 properties in the entire city. These parameters are not arbitrary. I want properties of substantial size so we can afford to have a professional property manager on site to handle the day-to-day issues. The year 1988 is important because many properties older than that take a lot of money to bring up to the standard of other apartment buildings in the area. You will find it's normal to replace roofs, paint, install new carpeting, and so forth. But if all of the other apartment buildings in the area have washer and dryer hookups and yours doesn't, you will either have to spend lots of money remodeling and updating, if possible, or charge below market rents. Neither is a good alternative. See what I mean about knowing your market? By targeting properties that have owner-managers who live out of state, I have found there is a higher likelihood that they are not managing the property to its full potential. There are a number of likely reasons for this. Travel. Often people buy property in hot markets that are far away from their own hometowns and underestimate how much time and energy is required to manage it. Add in travel time and expenses to that, and you can see why absentee ownership is prevalent. Complacency. It's easy for out-of-towners to lose interest and become complacent over time, especially if they are making money and their property isn't one they drive by every day. Perception. Many owners wrongly believe that the investment real estate business is an investment and not a business. They think it is like a stock or a bond that they can buy and forget. In truth, it is a business they need to operate. Lack of information. This actually happened with a property my company manages. The owners have no idea at all about the market potential, or the condition of the property itself. The owner bought the property, sight unseen. Learning about your market to the level of detail that will make you successful in this business continues during this phase of the process. At last, you are drilling down to individual properties, and there are a lot out there. You'll want to make sure your target market isn't too big, or you will end up considering thousands of properties. Recall the concept of markets and submarkets. In San Diego, you have the Gas Lamp Quarter, Balboa Park, SeaWorld area, Old Town, and Coronado Island. In New York, you have Greenwich Village, Soho, Upper West Side, Upper East Side, Tribeca, Harlem, Midtown. Then there are submarkets within those areas. Know where you want to be specifically, and start there. You may have to work your way outward or to other submarkets if there is nothing in your first choice market. Becoming an expert. You need to become an expert in the submarket you select, and a good deal of that learning happens during the market evaluation phase. But it also happens as you are evaluating properties. Adopt the mindset that learning is ongoing and forever. You never know enough about a market, and the market is constantly changing. I look at everything around me in terms of real estate. Call it a sickness, but every story I read in the paper, every conversation I have, every retail center I see has real estate implications to me. I see them everywhere. But if your senses are not as honed as mine, here are some guidelines to help you achieve expert status. Use your research. The research that you have done in preparation for property investment should be organized and usable. I have market and property information organized so that I can refer to it at any time. The research that you did months ago should be continually updated. Real estate is a fast-moving business, so I do research all the time. Anything that I see that pertains to my target markets, I catalog and keep. Anything that pertains to markets I'm not currently targeting, I catalog and track. You just never know when a sleepy community like Litchfield Park, Arizona, will pop onto the radar and become a boom town unless you track it. Read everything. I read every newspaper I can get my hands on in our target markets. Sure, I glance at all the property listings, but more important, I look at the news, the sports, the neighborhood happenings. That's where I get a real picture of the market. Take, for instance, the school district passing a bond initiative to build another elementary school. That's the kind of news that will draw people to a community. Similarly, things like new retail centers, zoning of a land parcel, crime reports, all have real estate implications. So do feature stories that rank communities with the wealthiest zip codes, that have the lowest crime, and that have the best school test scores. Even the morning traffic reports tell you something about a market and its desirability. Look around. Before you seriously target a property, look hard at the neighborhood. I know this from experience. There are several apartment buildings we manage but do not own. One building, when we took over managing it, was so full of gang members, drugs, and violence that anyone reputable was long gone. It was a haven for criminals. Worst of all, it was right in the center of a neighborhood riddled with crime. Things were so bad that in one apartment I entered during the site visit, there was an M16 propped up next to the door. Honest truth. We managed to clean up the apartment community through mass evictions and the hiring of off-duty city police officers to patrol the property 24 hours a day. We made it undesirable for criminals, and slowly good people moved back in. But the apartment building was all we cleaned up. We did not change the neighborhood, and that's the lesson. You cannot change the neighborhood, so make sure the property is in a place that you're prepared to manage. Listen more than you talk. Listen for the word on the street, the buzz. Not just what the news is saying, but rather what people are informally talking about. Shop owners, other apartment owners, neighbors, utility meter readers, cable technicians, mail carriers, UPS carriers, everyone who spends time in the market. Listen to what the insiders on your team are talking about. Listen to where they say they are going next. But don't be fooled by rumors. If you hear something, verify it with your team of experts and others with opinions that matter. Join a business networking group or trade association. Often you can find groups that meet regularly and have similar goals as you. I am active in the local Arizona Multi-Housing Association, as well as in the National Apartment Association and the Institute of Real Estate Management. These are good places to meet people who might be valuable additions to my team, to find people I may want to hire, and to stay on top of issues that could affect my investments. Search on your own or hire out. You can do all this pavement pounding yourself, and it's probably a good idea regardless of which path you choose, to hire or not to hire. For one, you'll be smarter about the property you might purchase, and two, it will make you a better judge of properties presented to you by the broker you hire. But hiring this service out has its benefits. Brokers will help you find property in your market and will do it on a 100% commission basis. First, brokers tend to specialize in their markets, so choose one who is a specialist in your target market. If you make a good selection, your broker can be a wealth of information to you. They know the new retail stores that are coming into town, the new roads and highway projects, even employers who are expanding or downsizing. Second, brokers save you a lot of time. They will be able to find property quickly and present you with choices. Third, brokers can make calls to property owners for you so you can cover more ground. Nothing is for sale. After weeks of narrowing your market, learning everything there is to know, and talking with business leaders in the community, your broker gives you the bad news. There's nothing for sale that meets your criteria. So, now what do you do? Should you move on? Start looking in another part of town? Wait until something suitable comes on the market? Of course not. You simply make a move to buy property that isn't technically for sale. I believe when a property is listed, it is too late. By that point, you're competing with other prospective buyers and working with a seller who has established a purchase price that he or she may want to stick to. When I see a wave worth riding in a particular area, I don't wait for the for sale sign to get plunked into the ground. I go for it. Often, the for sale sign never makes it in the ground because other people recognize the trend before you did, and they beat you to it. The issue here is about the real estate and buying it right. It's not about whether the property is for sale or not. You've heard the saying, everything is for sale for the right price. Well, the same is true here. Most of the properties we purchased in 2002 were not listed for sale. They were all acquired by making the first move and contacting the owner. So, how do you do that? Contacting the owner. In less than 10 minutes on the internet, I can find the value of almost any house, how many square feet it is, how many bedrooms and baths it has, what was paid for it and when, where it is located, and in many cases see an actual aerial photograph of it taken by a satellite camera. Does that surprise you? Well, you won't be surprised for long because this is exactly the type of information you'll be pulling off the internet yourself as you investigate properties. Everything I just mentioned is a matter of public record. None of the sources to find this information are illegal or shady. In fact, most all of them are government agencies. My point here is simply, if I can find out that information about your house, you can find it out about any building you are interested in purchasing. That includes the name, address, and phone number of the owner. That's one easy way to find out information about a property. You can also take the direct approach and ask residents, the property manager, real estate brokers who work in the area, the tax assessor's office, and title companies. Sometimes, as you look for the owners of a property, you'll discover it is owned by a corporation, not a person. Don't let that stop you. Call the Corporation Commission in your state, and you'll be able to get the names, addresses, and phone numbers of the corporation officers. Nothing is secret. Once you have enough facts about the property, you'll want to call the owner. This is the best way to find out more about the property and see if the owner would entertain an offer. Making a phone call can be scary at first, but not if you are honest from the get-go. There is no need to tap dance. Just ask the question and be prepared for rejection. To help you through the first conversation with the property owner, please listen to the following example.
Hello?
Hello. My name is Ken McElroy. Are you the property owner at 555 8 Plex Avenue?
At this point, the owner is thinking you are a mortgage broker trying to get him to refinance. Or he or she will want to hang up.
Yes, I am.
Your property is one of 10 that fits my parameters of an 8-plex in Old Town Scottsdale, and I'd like to talk to you about buying it.
Now the owner is thinking, who is this guy and is he reputable? Is he a broker or just trying to get a sales listing, or is this a real buyer?
I might be interested in that. What did you have in mind, Ken?
First, I'm not a broker looking for a listing, and I'd like to say that everything we talk about here is confidential, and I'm prepared to send you a confidentiality agreement. I'll fax it to you immediately, signed by me.
The owner is now thinking the confidentiality agreement is very professional. This sounds legitimate.
What kind of money are we talking about?
I'm not prepared to make an offer today, but once I find out more about your property and its operations, I'll get a formal offer to you within a week. If you can give me some basic information, I could get an offer started right away.
At this point, you are not in a position to make any kind of offer because you don't know how the property is operating. Remember, buying right is about buying based on operating performance.
My offer will be based on a return on my investment, and I won't know what that return is until I look at the operations of the property.
The seller may be reluctant to give this information, or he or she may be open to it. You must make the owner understand that he or she is risking nothing by giving you this information, and that he won't ever get an offer unless he or she does.
What kind of information do you need?
For starters, I'll need the rent roll, and your current occupancy. We'll also need your operating expenses.
These two pieces of information are critical to establishing the purchase price, as you'll see in the next section. You will likely find you are educating the seller here and helping him or her determine what the property is really worth.
I don't want to send you that information.
Okay. I can make you an offer without it, but unless I know how the property is operating, the offer may change dramatically should we decide to go forward, and I will see this information during the buying process. I'd rather be informed now and provide you a reasonable offer right up front. If nothing else, you'll get an assessment of how much your property is worth. I'd rather not have to renegotiate further down the line.
The owner needs to understand that there is no risk here. This is information you'll need to know sooner or later, and sooner is better. As you'll see in the next section, you'll review the property operations in detail before you buy anything, so there's no point in keeping this information secret.
Tell me a little bit about you and your company.
If the owner asks this question, be prepared with your 30-second speech about your company.
We're a real estate investment company here in town, and we're looking for properties in this 1-mile area near the Old Town Scottsdale Center. With the right information, we're prepared to make an offer within 1 week.
The idea here is to make sure they know you are professional and credible and that you mean business. You must demonstrate that you are capable of pulling off the deal and that you are decisive about what you want.
That sounds fine. I'll get you the information you need.
To conclude the call, restate the action items and set up the delivery dates.
To summarize then, you're going to get me the rent roll, current occupancy, and operating expenses by tomorrow morning. I'm going to send you my confidentiality agreement immediately, and I'm going to send you my offer letter within a week of receiving your information.
Fine. I'll look forward to hearing from you.
Great. I'll get back to you. Thank you for your time. Goodbye.
Now, what if the seller is not interested? The conversation might go something like this.
No, I'm not interested.
I see. Can I send you my information just in case you reconsider in the future?
In the event of rejection, don't burn the bridge. Many of the properties I own today were originally owned by people who were not interested in selling at first. Stay in contact with these people and call once a quarter. Put them on your mailing list. Contacting the owner can be easy, providing you steer the conversation in the direction just demonstrated. The goal with the first phone call is to try to educate the seller and build a relationship. There are two kinds of sellers, one trusting and the other untrusting. Some people may give you lots of information, and that helps. Others may be secretive and not want to divulge anything. Either way, keep accurate notes of everything stated because what is stated in the conversation is highly material to any future negotiations. Learning and networking. Whether your first contact with a property owner leads to an eventual purchase or not is not that important. The whole exercise is worth the practice and the learning that can only come from doing. I find that no matter how much I think I know about a market, I always come away from conversations with property owners knowing more than I did before. You'll be surprised at how quickly you will come to know a market or submarket by talking to property owners within it. As a side benefit, I also know I've established another entire network of people for future leads. I found several properties this way. One building I now own came my way from a property owner who didn't want to sell the building I initially contacted him about. Instead, we ended up doing a deal on another property a few miles away. This happens often. This whole process is about becoming an expert, putting out feelers, and getting some action going. So don't be discouraged if your first calls are rejections. It's like fishing. You put the worm on the hook, cast it out, and see what comes back. Eventually, one or two will bite, and then the real action begins. And that's the focus of our next section, determining the initial valuation of the property. Is it really a diamond? If you forget everything else you hear in this audiobook, this is a section I hope you not only remember, but refer to often. Because if you master the process I'm revealing in this section ahead, your life as an investor in rental property will be infinitely easier. Infinitely. It's true that your success in this business is a result of your preparation. That's the message and the purpose of the early parts of this program. But regardless of how prepared you are, you can create a disaster for yourself in a matter of seconds if you can't tell a diamond from a cubic zirconium. That's the time it takes to sign your name on a dotted line of a bad deal. I know that sounds pretty scary. There is little gray area separating a good deal from a bad one. And to me, gray area is made up of black and white. A deal is either good or bad, and fortunately, a bad one is easy to define. It is simply a deal where the numbers don't work. In other words, it's when the projected cash flow, income minus total expenses, equals a low or negative number. Remember, in good deals the numbers work, in bad deals they don't. Does this seem terribly obvious? Of course it does. But you'd be surprised at how many times investors ignore this simple truth. They purchase property based on the seller's asking price, or something close to it, instead of the operational performance of the property. Here are a few principles about property investing we need to get out on the table right now. The seller's asking price is irrelevant. You determine the property value, which becomes your offer. With multiple units, the property value is based on the current cash flow of the property. These three principles are the foundation for everything else in this section. That's because in this section, I will walk you through my own personal system for determining property valuations for multiple units. It's called the 5-step property evaluation, and I've used it for the past 15 years with outstanding results. Here it is in a nutshell. Number 1, verify property income. Number 2, verify expenses. Number 3, determine net operating income. Number 4, find the capitalization rate and valuation. Number 5, calculate the loan payment and your return on investment. I use these 5 steps to come up with the initial cash flow for a potential property and arrive at an offer price. To do that, we analyze everything associated with expenses and everything associated with income. In the end, we have a solid picture of the bottom line and are in a good position to make our initial offer. You'll realize the importance of this process when you think of it this way. Would you put your money in a mutual fund without looking at its past earnings performance? Would you put your money in an annuity if you did not know the annual interest rate? Probably not. Well, why invest in real estate without a reasonable estimate of what your return on investment would be? In real estate investing, return on investment is also called cash on cash, and it is your net cash flow as a percentage of your down payment. For instance, if you put $100,000 down on a property and it brings in $1,000 of income per month, your cash on cash is 12% per year. Not bad. But if that same property brought in $500 per month, your 6% return may not seem worth your time. Step number 1, verify property income. Even if the seller discloses the current income on a rental property either through a pro forma document or verbally, verify it. Property income is perhaps the most important factor when it comes to buying investment property. Unlike your primary residence mortgage, which the bank secures with your own assets, rental investment property loans are most often secured by the income-generating potential of the property itself. If you don't verify income right up front, you'll have to do it later for the bank. So there's no time like the present. And this one variable will tell you without going any further whether this property is worth any more of your time. Before we get too far, let's define some terms. There are 3 types of income to consider with any property: actual income, actual potential income, and future potential income. Actual income is the total income the property generated in the prior 12 months. Actual potential income is the total income the property could have generated in the prior 12 months had all units been 100% occupied and had the owner taken advantage of all other income opportunities. Future potential income. The total income the property could generate at today's market rents, 100% occupancy, and taking advantage of all other income opportunities. Traditionally, property owners will try to sell their property based on the future potential income. It is in your best interest to buy it at the actual income. That's the way I like to buy, based on the amount of money the property is currently making. I think of that as wholesale. If you buy property based on how it could run and the income it could generate in the future potential income, I call that buying it retail. Try to avoid retail purchases at all costs. When you buy wholesale, your mortgage is lower, and right out of the gate, that means you are maximizing your profitability on the property. With the important distinction between retail and wholesale out in the open, trust but verify all numbers listed on the back of the sales brochures you get from the brokers and sellers. These sales brochures have a fairly standard format. Usually on the front there is a photo of the building, and on the back there are a lot of numbers that depict the property's operations performance. You simply cannot accept these numbers as fact, since they are often inflated. Before you start a rumor that Ken McElroy is a broker hater, know that on the bottom of every sales brochure I have ever seen are these words: "This brokerage company makes no warranty or representation about the content of this brochure. It is your responsibility to independently confirm its accuracy and competencies." This disclaimer makes it pretty clear that a smart investor must verify each and every number in this brochure. If you don't, they are basically saying, it's your own fault. But how do you verify the income numbers on a typical property pro forma in a sales brochure? The information I'll use in the following example, which is also included in the printed insert, is from an actual property in Phoenix, Arizona. Let's start with the unit mix and rent schedule. The unit mix and rent schedule is a table that lists the number of units, the type of unit, i.e. 2-bedroom versus 1-bedroom, square footage, and rent. Its purpose is to give you a picture of the income by unit and overall for the property. It's important to know how to read and analyze this information, since I have yet to ever find one that accurately depicted the actual income picture. For example, in the sample table, the owner is telling you that the total rent for the 8 units is $4,000 per month. But look a little closer. The seller has put asterisks next to the individual rents to indicate that the actual rents are lower, significantly lower. See the small print. An inexperienced buyer might glance at this table and conclude that $4,000 is the actual income of the property. But by the seller's own admission, which is rare by the way, this $4,000 is the future potential income based on higher rents, which may or may not be at the market rent levels. Let's see how the income picture changes when we insert into the table the actual rents. We see that the rents used by the seller or broker were a full $63 per unit higher than what the property is actually generating. Over a 12-month period, that equates to $6,048. If you would have bought this property based on the seller's pro forma, your income would have been more than $6,000 below what you expected. That's not good. But what if the seller doesn't reveal the actual rent numbers in the small print on a brochure pro forma, and they usually don't? Then you must request a rent roll, which is merely a listing of the renters at the property and the rents they are paying, and use those numbers for your calculations. Trust but verify. What about vacancies and other income? At this point, we can verify the actual potential income for the property. Remember, that's the income the property could generate at current rents with 100% occupancy. But it is highly unlikely that this property is or will be 100% occupied every day of every year from now until eternity. So we have to take into account vacancy and turnover from residents moving in and out. And while we're at it, we should consider any other income generated from sources like laundry facilities, parking, and so on. The typical pro forma lists these values as well. And surprise, these numbers too, I have found to be inaccurate most of the time. Vacancies are usually understated and other income is usually overstated. The key here is to try to project what the vacancies and other income will be in the future. It's nice to know where you've been, but where you're going is really more important. That's why the windshield is so big and the rear view mirror is so small. The income section on the pro forma is where the seller shows the income from rent minus the average vacancy for the property and adds it to the other income the property generates. Again, there is an example of an income table with the audiobook insert. In this real-world example, the seller or broker is reporting a total income for the property to be $45,120 per year, using a 7% vacancy rate and $480 in other income. That seems pretty good, but look at the rent figure. It's based on the inflated rent numbers listed on the unit mix and rent schedule. When we insert the real rents into the income table, the total income for the property falls by $5,669. As I'm sure you have guessed, when I formulate my offer, I disregard the seller's income numbers and use my own projected figure, the one that takes into account the real property rents. The best part of this strategy is that because the numbers are real, they are easy to defend during the negotiation process. This is how easy it is to verify income and how easy it is to catch these kinds of inconsistencies in the numbers. As I mentioned, income is often inflated, so don't be shocked if the difference between the numbers on the pro forma and the numbers you project are in the thousands. That is common. Before we leave the topic of income, let's address future potential income. Recall that future potential income is the total income the property could generate at today's market rents, 100% occupancy, and by taking full advantage of all other income opportunities. You may or may not find through your income verification process that the reported rents are well below the market. If they are, this could be your advance to boardwalk card. So keep this information close to your vest. It is this kind of upside potential that property investors dream about. With income verified, it's now time to turn our attention to expenses. Step number 2, verify expenses. In the previous section, we showed you how to estimate the income potential of a property. In this section, we'll assess the expenses. The goal throughout this exercise is to get a picture of where your expenses are and try to find ways to do things better, smarter, and for less money than the owner. Unlike the income calculation, where your goal was to be 100% on the money in terms of accuracy, with expenses, the goal is to get reasonably close. We'll find out all the minute details later in the game, when we begin a process known as due diligence. Regardless of whether you will be using a property management company or not, calling one to visit the property and help you assess everything involved in running the place is a good idea. Just call and say, I'm looking at buying an 8-unit building and I'm not sure if I want to run it myself or hire a company to do it. I'd like to show you the building and talk with you about it. The hour or so you spend with the property management representative will be a good investment of time. And if you have to pay that person an hourly consulting fee, it's worth it. Make the objective of the meeting twofold. First, you want to learn what it will take to run the property. And second, you'll want to get insight on how to minimize expenses. Keep in mind, at this point in the process, your goal is to get an idea of the ongoing services and repairs as well as upgrades the building might need. This is the time to put rough numbers on paper and analyze if the cost of the needed repairs will still allow you to be profitable. So what are the expenses? To answer that question, we'll need to examine an expense table, which shows the seller's anticipated expenses for the coming year and the actual expenses for the prior year. If you look at the sample expense table we've included with the audiobook, the line items you'll find are repairs and maintenance, utilities, real estate taxes, insurance, and replacement reserves. First, we'll look at repairs and maintenance. The first thing that caught my eye on this table was that the seller pro forma number was lower than the prior year actuals. For some reason, this seller or broker wants us to believe that the repairs and maintenance will actually go down by $1,300 from the prior year. Here's a rule of thumb. As properties age, repair and maintenance costs go up. So for purposes of my projections, I will use the prior year actuals number of $8,010, knowing that even this number could be low. Next, we'll look at utilities. Notice that the seller's pro forma utilities figure appears to be in line with the actual expenses from the prior year. But let me caution you that utilities normally have standard rate increases from year to year. In this pro forma, the seller projects no increases. For now, we'll use the seller pro forma number, but you can get a very realistic projection simply by contacting the utility companies. How about the next line in our expense table? Real estate taxes. Real estate tax expenses are simple to determine with almost pinpoint accuracy. The data is usually available on the internet. Simply go to the county assessor website and locate the property search area of the site. Then type in the property address to get the current figures. In most cases, you'll see not only the prior year property tax amounts, but also projections for 1 or 2 years out. Focus on the future and use the next year's assessment as your projection. But understand that property sales often trigger tax increases, so you may want to consult with your real estate tax team member about this. For the purpose of expense evaluation, I'll just say I found the seller's figures to be accurate. The next item in our expense table is insurance. Insurance rates can vary widely from company to company, so my suggestion is that you get a couple of insurance agents to bid on the property and use that number in your projections. As your business grows, you can bundle all your properties under a bulk insurance program, which generates substantial savings. Finally, we'll look at our replacement reserves expense. The replacement reserves are the funds you put aside for the inevitable replacement of capital items, such as appliances, carpets, countertops, roofs, and so on. I get really nervous when I see that the seller did not spend a dime on the property in the prior year, as our sample table indicates. Moreover, the broker or seller projected an additional $1,200 for the new buyer, and trust me, this is no gift. This tells me that this property has some deferred maintenance, and it's probably more than the $1,200 figure. Adjusted expenses. At this point, we have the numbers we need to complete our expense analysis. To do this, we simply get out our calculator and run the expense totals to see how our numbers differ from the seller's pro forma numbers. And what we discover is the difference is significant. From $15,573 to $17,083. That's a $1,510 difference that may have come right off your bottom line. Step number 3, determining the net operating income. After you have determined your income potential for the property and you have a good estimate of the expenses, you need to determine the net operating income, or NOI. This is a very important number because you will eventually base your offer on it. To calculate net operating income, you simply subtract your expenses from your income. Hopefully you end up with a large positive number. The larger the better. But before you get too excited when you see the number, which is one indicator of net cash flow, remember that this number does not include your loan payment. The loan payment will be determined by how much you pay for the property, your down payment, and the interest rate. To calculate net operating income on the example we've been using, we simply take our projected total income of $39,451 and subtract our projected total expenses of $17,083 to get an NOI of $22,368. Notice the seller pro forma net operating income is a full $7,179 higher than ours. This is a significant difference and would certainly have set up an unsuspecting buyer for failure. Step number 4, Find the capitalization rate and valuation. I know you're thinking this is starting to sound complicated. Definitely third-year college accounting. Well, before you turn off your CD player, allow me to explain. It sounds way more complicated than it is. In numerical terms, the capitalization rate equals the net operating income divided by the purchase price. Let me repeat that. The capitalization rate equals the net operating income divided by the purchase price. So now you're thinking, Ken, how can I calculate the capitalization rate when I don't have the purchase price yet? That's what I'm trying to figure out through this whole exercise after all. This is actually really easy. The purchase price we use here is actually the purchase price trends for a comparable building in your market. So this very complicated sounding word is actually something you can get very easily from brokers, real estate agents, or even the pro forma document for the property. Your team members will either know the capitalization rate for the market or help you calculate it, and that's all there is to it. To determine how much the property is actually worth, in other words, the property's valuation, you just divide the net operating income by the capitalization rate. The number you arrive at is the valuation. It was called purchase price in the previous formula, and the valuation is your initial offer. Let me repeat this. To find how much the property is worth, simply divide the net operating income, a number we already estimated, by the capitalization rate of a comparable piece of real estate in our target area. So let's continue with our real-world example. The capitalization rate used in the Phoenix property pro forma was 8.74%, a standard rate used by the broker. At this stage, I'll just use the capitalization rate provided. So we'll divide our net operating income by our capitalization rate, and in doing so, we arrive at a property value and an offer price of $255,926. We've arrived. We have an offer price, but there's something missing. Oh yes, you're probably wondering what the seller's asking price was on the property. I won't keep you in suspense. The asking price was $338,000. That's an $82,074 difference. If you purchased this property with a 10% down payment, this would have been a loan payment of $25,524 using a 7.5% interest rate. Remember our projected net operating income? It was $22,368, a $3,156 difference. Can you see the problem? The income falls well short of even covering your loan, let alone anything else. Had you bought this property at the list price of $338,000 or even at $300,000, you would have been in a negative cash flow situation immediately. And just in case you're thinking that I pulled our example pro forma from a small-time brokerage company, guess again. It was quite the opposite. This pro forma was prepared and distributed by one of the nation's top brokers. Step number 5. Calculate the loan payment and your cash on cash. Let's assume that you and the seller agreed to a purchase price of $256,000. If you put 10% down, or $25,600, and use the interest rate of 7.5%, your loan payment is $20,010. Certainly, a more palatable number when you consider your projected net operating income, which is $22,368. The very last step is to find out your actual profit by subtracting your loan payment from your projected net operating income. Using the net operating income of $22,368 and subtracting the loan payment of $20,010, the projected profit on this property is $2,358. Is that good or bad? Well, here's how you know. To calculate the cash on cash, divide your profit of $2,358 by the down payment of $25,600. For this deal, your cash on cash return is 9.2%. Not a bad return. Congratulations. If you purchase this property for $256,000, With 10% down, your return on investment will be 9.2%. These 5 steps, the 5-step property evaluation, are the most important concepts in this audiobook. They give you the ability to evaluate property investments like the pros do. They give you power and confidence. They give you realistic, fact-based benchmarks to make the best property choices. They give you the basis from which to have reasonable conversations with the seller, and they give you peace of mind that you are not getting into something that may not pan out. If you spend the time gathering the income and expense information clearly prescribed in this section, you'll know what it will take to run this property and how much money you can expect to make from it. You'll be well informed before you even talk to the seller again, and certainly before you ever make an offer. I buy all my rental properties this way using these exact same 5 steps. I would never dream of doing it any other way. The big commitment. The last section was all about determining the valuation of our property. The 5-step property evaluation is like embarking on a fact-finding mission where you search for the information you need to create a snapshot of the property. I say snapshot because you really won't know everything there is to know about the property. You'll have a good idea of what the property is all about and a sense of how it got to be that way. You may even have an idea of how it will perform in the future, but you'll know far less than 100% of all there is to know. And that's okay. At least the picture is concrete and real, based on numbers and facts. There will be time to find out all the minute details during the due diligence phase, which occurs after you and the seller have agreed on a purchase price. Before we go any further, I want to point out that if after your analysis, the net cash flow on your target property is too low, then you may need to walk away from the deal or offer a much lower price to make the numbers work. These numbers don't lie, and unless your math is wrong, the estimates you've arrived at are factual. It is perfectly okay to walk away, although you may feel like you did a lot of work for nothing. But remember, every step in this process is a learning experience, and with every exercise, every calculation, every building walkthrough, you are getting smarter. Learning is never a waste of time. I walk away from most deals at this critical point. I make this statement because by now most people are emotionally involved in the property and the process and are reluctant to say no-go to a deal. It takes me about 30 minutes to do the 5-step property valuation process once I have all the information I need. I use the numbers and my common sense to move to the next deal if the one I'm working on doesn't jibe. Should you decide the property still looks like a good idea, you'll find your high level of preparation will put you in an excellent position for negotiations because you'll have all the numbers and all the facts. But let's be real. There may be some hostility on the part of the seller who thinks the property is worth far more than you've shown it to actually be. That happens often. But the difference is that armed with the numbers, you are not waltzing into the seller's office making an arbitrary lowball offer. Instead, you are coming in with a well-prepared case based on research and facts calculated with industry standard formulas and a realistic offer number. Kick and scream as the seller may, you'll both know that the offer you are presenting is a fair one. It just may take the seller a little longer to arrive at that conclusion. Now it is time to convince the seller to sell the property to you. When you feel good about the numbers and arrive at a decision to buy, you have reached a milestone. In this phase of the process, the goal is to tie up the property. What I mean by that is you want to get the property off the market by beginning the process of generating the letter of intent, or in some cases, executing a purchase and sale contract. As soon as the purchase and sale agreement is signed, the property is no longer available to any other competitive bidders. The quicker you can tie up the property, the better chance you have of closing the deal at your price. Regardless of whether it takes 2 days or 2 weeks, once you make a decision to buy, there is a standard protocol for buying investment property. Remember, the goal is to tie up the property, and during that time, you negotiate the terms of the sale and, equally as important, review the property and its operations in its finest detail, also known as due diligence. By the time you are done, You may find your offer was too high and needs adjustment, or you may find it was right on the money. Letter of intent. Once I've established the property valuation using the 5 steps in the last section, I prefer to use a standard letter of intent to map out the deal points between myself and the seller before moving to a formal purchase and sale contract. Letters of intent save me a lot of money in attorney's fees, because attorneys are not usually involved in these negotiations. Furthermore, the work done during this process makes the actual contract negotiation smoother and faster. The letter of intent contains my offer along with the basic deal points like down payment amount, due diligence time frame, escrow amount, and financing contingencies. We'll get to contingencies in a minute, but for now you can see why it is a good idea to have your team in place early. The last thing you want to do at this stage of the game is begin relationships with banks, title companies, or investors. You want the relationships to be established. Time is of the essence. Get your letter of intent out as quickly as possible so you can agree on the basic terms of the deal and tie up the building. Letters of intent are like a proposal you send to the seller. They are designed to be negotiated, and the original document you send over is the starting point. The seller will review the offer and the terms and will usually counter the offer and adjust some of the terms. This is a back and forth process, so don't be surprised if it takes weeks to accomplish. That's normal. Realize, even though you are actively negotiating the terms of the sale with the seller, the property is not off the market. In fact, I recently lost a property during the letter of intent stage. It felt like you can imagine it felt. Unbeknown to us, the seller was working with another buyer and used our offer to increase the offer of that buyer. The seller ended up completing a purchase and sale agreement with the other buyer, and it went into escrow. Not a good feeling, but it happens more often than you think. But don't burn the bridge. This property came back to us 3 months later when the first buyer couldn't get financing, and we later put the property into escrow. Sample letters of intent are available at my website, www.mccompanies.com, and will give you an idea of what these documents look like. Typically, your real estate broker will prepare letters of intent, and you will verify and approve them. Note that a letter of intent is usually not binding. It is just a letter that delineates your intent to purchase the property and the terms of that purchase. Purchase and sale agreement. Once both the buyer and seller agree upon the terms in the signed letter of intent, you are ready for your attorney to draft up the purchase and sale agreement, or you can use a standard form from an agency you may be working with. This is where you communicate all the specifics of the sale. In other words, you list exactly what each party is going to do to complete the deal. These can be tens of pages in length, and some negotiation takes place here as well. Purchase and sale agreements always spell out how the seller will provide information on the property's current operations. They list critical dates, including when your deposit becomes non-refundable, when the due diligence evaluation period ends, and your close date. There can be plenty of back and forth between the buyer's and the seller's attorneys, but this usually goes much quicker than the letter of intent. That's where the bulk of the deal is hashed out. When you get ready to actually sign the purchase and sale agreement, you will have to put down earnest money, which usually is fully refundable until the completion of the due diligence process and you've secured financing, which we'll talk about later. There is some important language that I make sure is in every contract we sign. That language is as follows. Purchase price. What is the total price? Down payment. How much do you need down? What is the initial deposit to open escrow and start your detailed research? Who holds the buyer's deposit in escrow, and when does it become non-refundable? What are the time frames after the agreement acceptance date, especially for contingencies and close of escrow dates? What are the prorations for rents, taxes, insurance, security deposits, all of which should be split between buyer and seller at close of escrow? When will the title report be delivered and what is in it? What are the financing contingencies, including getting a new loan or assuming the existing one. What are the due diligence timeframes, including receipt of all books and records, rental agreements, operating statements, rent rolls, personal property inventories, service contracts, utility information, property line surveys, environmental reports, building plans, engineering reports, or any recent appraisals? As the buyer, you must receive all of these before the due diligence period begins. What is the time frame to perform the pest control inspections? What are the time frames for the physical inspections of all interior and exterior spaces, including units and common areas? Does the seller have any information with regard to lead-based paint or mold and other allergens? Again, the contract law governing the sale of commercial property varies by state, so you want to make sure that you consult a qualified attorney. By now, however, you should have one on your team, and he or she should be familiar with your specific goals. Work closely with your attorney and your broker to make sure you receive the items promised in the agreement on time. Contingencies. Your attorney will be able to advise you about contingencies. Contingencies are provisions within a contract that give you recourse to cancel the deal in event of unforeseen circumstances. A few examples of a typical contingency include loan contingencies and due diligence contingencies. These are critical, and I recommend that they be in every purchase and sale agreement. A loan contingency states that a sale is contingent on you qualifying for the loan. This gives you an out should a lender refuse to finance the deal. I won't do a contract that doesn't have a loan contingency. We were managing a project where a buyer put a deposit of $200,000 in earnest money on a property that didn't have a loan contingency. He didn't get the loan. The sad ending is that he lost his $200,000. True story. Due diligence contingencies are equally as important. This language in a purchase and sale agreement states that you as the buyer are entitled to any and all documents related to the property. It also states that you as a buyer may ask any questions about the property and that you are due answers from the seller to the best of his or her knowledge in a timely manner. As you will come to find out in the next section, the results of the due diligence process are ultimately what decides your purchase or decline of the property. They also help you formulate your property plan and operating budget, two steps critical in maximizing your investment. This clause ensures that you get all the information you need. Signing the agreement. Once both the buyer and the seller agree upon the terms of the agreement, you have a completed purchase and sale agreement that is ready to sign and date. This agreement is binding, and in most cases you will be asked to put down an earnest money deposit on the date that you sign the contract. Again, this earnest money is fully refundable, and you can walk away from the deal until you have completed and waived the contingencies such as due diligence and getting the loan. And that's what we'll cover in the next section. But as binding as the agreement is, with the right language built in, you can walk away, extend your dates, or adjust your offer based on the findings during due diligence. We have rescinded our offers on a few properties for just cause. In fact, there was one property that we pursued through the signing of the purchase and sale agreement. During the due diligence investigation process, the structural engineer on our team found that the building was built on what they term in Arizona, expansive soil. What that means is that the soil expands and contracts more than normal and can cause foundation problems. Knowing that, we looked further and found a 20-foot hairline crack in the pool, small foundation cracks, and exterior wall separations. This was indicative of bigger problems that could be incredibly costly, and we felt the risk was too great. So we sent a letter to the seller stating that we were rescinding our purchase offer in accordance with the terms of the agreement. Due diligence, the Easter egg hunt. The goal of due diligence is to find out 100% of everything there is to know about a property and generate an operating plan and budget from that information. It's the time when you make detailed assessments of actual costs for property improvements, ongoing maintenance, and operations. It's your last chance to make sure that you have uncovered every hidden flaw, are aware of every possible problem, and are realistically projecting the opportunities. In my years of buying property, I've uncovered everything imaginable during due diligence. In one building, while doing a unit-by-unit walkthrough, I found everything from vacant units that were supposed to be occupied, falsified rent rolls, units that cannot be leased because fixtures have been removed to repair other leased apartments, cannibalized units, roof damage so bad I could see daylight, units missing carpeting and appliances, a 10-foot-long boa constrictor, you name it. To me, due diligence is really kind of fun. It's like a month-long Easter egg hunt. You just never know what you are going to find. But unlike my preparation for an Easter egg hunt, I come to the due diligence process with more than an Easter basket. In all cases, because I was thorough on the initial property valuation, I have a strong belief that whatever I find is fixable. I also take comfort in knowing that anything I find that would cost me money to fix is a final negotiation point before the sale closes. That's right. If you find that a property requires any type of major repair, such as a new roof, exterior painting, new appliances, termite extermination, snake removal, you can get estimates and factor the costs into the final valuation and purchase price. That's what I call finding the golden egg. The due diligence checklist. Over the years, I've gotten really good at due diligence. I've seen it all, and our due diligence checklist is compiled from over 15 years of experience. For years, every time we thought we had everything on the list, we'd encounter a property that would throw us a curve. The purpose of this entire inspection process is to put an estimated cost to each item in the list, so that we can take our list back to the seller and discuss. What if the property is not in compliance with the fire department? What if there are environmental hazards? What if 3 out of the 8 units obviously need new carpeting? In many cases, if you bring these issues to the seller's attention, they can be fixed before you close. That saves you money. In some cases, lots of it. Books and records. As important as it is to know everything about the physical property, you absolutely need to dig just as deep into its operations. That means looking at the books and records. This is also the time to begin gathering information for your operating budget by categorizing the income and expenses. These are the things I review in great detail. 24 months of income and expense statements. I compare the income and expenses to the projections. This is the time to make notes for the operating budget and flush out all the unusual expenses or major periods of rent loss. Discuss these with your seller or broker before the due diligence period ends. You absolutely want to meet your deadlines. All service agreements. I look for those agreements with termination clauses longer than 30 days. I verify that these costs are in the operating budget, whether the service is needed, and also what services are missing. I assess the current management company and determine whether they stay or go. I review all advertising agreements for effectiveness. It's worth your time to look at these agreements because you could find yourself locked into them. Any contract you don't want to assume, you need to spell it out before the completion of due diligence. Current rent roll. This is when I verify the actual income, the actual potential income, and the future potential income to the penny. Take a hard look at every unit that is under the market rent. This is your golden egg, advance to boardwalk card that will create an increase in your cash flow after you purchase the property. Take detailed notes for your management plan and operating budget. Utility bills. Here I verify all utilities. Call the utility companies and get the last 12 months operating history on each account. Ask about increases for the next year. Finally, insert the revised figures into your budget. Payroll information. On larger properties, I look at who is working at the property and how much they are paid, especially if I want them to stay and work for me or the management company. When assuming these employees, treat them like new hires. Be sure to find out the accrued vacation information. We also run a criminal and credit background check and a complete drug screening on all new hires. For me, the due diligence process is an exciting time. Sure, I get some great stories out of what I see, but more importantly, I know whatever I find will be documented for the next round of discussions with the seller. The due diligence document is my report card to evaluate how well I estimated the numbers during the 5-step property evaluation. In many cases, the problems I find during due diligence either result in a reduction in the price of the property or, better yet, they are fixed before we close escrow. It's this kind of information that is only going to help you be more successful with whatever property you purchase, this one or another. We recently found a new landscape company this way. I received a monthly landscape contract on a property we were considering. The landscaping looked great, and I was surprised to see the cost was much lower than what I was paying at some of my other properties. In fact, it was lower than what I had budgeted for this project. This one find is saving me thousands because now this landscape company does the bulk of our work at this and our other properties. Regardless of whether I find hidden jewels like a great landscape company I didn't know about before, or buried warts that if missed would have negatively impacted cash flow, I am happy. Happy because additional revenue opportunities are always great, and happy because any problems now in the open give me additional bargaining leverage. Only the stuff that isn't found during due diligence is scary to me. Once the sale is closed, you're stuck with any and all hidden problems, and they can cost a lot. Imagine not checking the property's drainage, only to find that after a big rainstorm, raw sewage drained into one or more of your apartments. Don't laugh. It happened to a friend of mine on Maui, and the costs to clean up all the damage and correct the drainage problem were huge. That's why, as you can imagine, I am very diligent during due diligence. You should be too.